Hi students, today we're going to look at a video on how to calculate and journalize depreciation. And we're going to do a series of videos on the different depreciation methods. The first one will use straight line depreciation. I could refer to this as everyone's friend because straight line depreciation is the easiest of the bunch. I find that most accounting students get this right pretty easily. It's somewhat intuitive and therefore comes to most people quite easily. However, we're going to look at an example today from two perspectives. One, a full year of depreciation, and second, we're going to look at how to calculate a partial year depreciation. And you will need a partial year depreciation if you buy it later in the year, not at the start of January. And also when you sell it, you'll need to record a partial year depreciation. So let's look at how we're starting here. We're purchasing equipment for $180,000. We're going to pay $30,000 cash and sign a note for the remainder. Now our residual value is $20,000 and our useful life is 10 years. So this is all the information along with the purchase date of January 4 anyway. That's all the information we need to calculate depreciation. So let's start with just journalizing this transaction. I thought that might be good practice for us. So here is our equipment, and that's $180,000. And we'll just format that. And it's partly note payable and partly cash. So we'll credit notes payable and we'll credit cash. And that was for 30. And then the remainder on a note would be the 150. So there's our journal entry to purchase the equipment. Now you'll note this was January 4. We are going to be rounding depreciation to the nearest month. So that means January 4 rounds down to January 1, the beginning of the year. We do not break depreciation up into, one day out of 365. The reason we don't do that is that there are way too many estimates in the depreciation amount to pretend to be that precise. So what I'd like you to know about depreciation here, no matter what method we're using, that we know we paid $180,000 for this equipment. However, it is our best estimate that it will last 10 years. It may last longer or not as long, based on our experience over 10 years or so. The other thing we're doing is we're estimating the residual value to be $20,000 in 10 years. We don't know if that's right. We can't look at a crystal ball and say, oh gee, in 10 years we'll sell this for 20. You might sell it for 10, you might sell it for 30, who knows. So two of the pieces of information we need are an estimate. So there's no point trying to say, oh, I'm going to do depreciation by the day and get 1/365th of the amount. It's kind of ridiculous. So we're rounding to the nearest month. January 4 rounds down to January 1, so we're going to calculate and journalize a full year of depreciation. So let's look at the amount. Let's do that over here. We're starting with $180,000. Just format this a little nicer. Okay, so we're starting with $180,000 as the purchase price. Next, using the straight line method, we deduct the residual value. So this is the estimate of $20,000 that we deduct. And then we find the difference. So that's $160,000. So we would call the $160,000 the amount to be depreciated. Now, it's going to last us 10 years, we think. So we're going to divide by 10. We're going to go take our 160,000 amount to be depreciated and divide it by the 10 years. Now that gives us 16,000 a year. Now in this first example, we're recording a full year's depreciation, and we've just calculated the amount as 16,000. That wasn't too tough, was it? So we're going to do our journal entry debiting depreciation expense and crediting accumulated depreciation. Now, it may be required of you to write depreciation expense dash equipment and accumulated depreciation dash equipment, and that's fine. I'm just not doing that in this video just to keep the typing to a minimum. However, we know that we have 16,000 as our amount, so we're just going to key that in to debit and credit, and there we have our end of year entry for depreciation expense. So that's not too bad. Now let's look at the same thing. However, we're not going to buy it on January 4. So here we're purchasing the same equipment, just so that we know our numbers. We're purchasing it on March 18. Now January 4, sorry, I shouldn't say January 4, I should say March 18 is the same entry as January 4 above, because that is simply the entry to purchase the machine, the equipment. However, here's how we do partial year depreciation. We round to the nearest month, and that means anywhere from the 1st to the 15th. Well, that didn't work. Let me try it this way. Anywhere from the 1st to the 15th, we round down. So we assume a full month of depreciation. However, anywhere from the 16th to, let's say, end of month, whether it's 28, 30, 31 days, 16 to end of month, we round up, meaning we do not count that month of purchase. So March 18, of course, is in the latter half of the month. So this means we round up, and that means we do not count March. Therefore, we do not count January and February and March. So we are going to depreciate this for 9 months. Now, if we had purchased this on March 5, we would say, oh, that rounds down to the beginning of March. Therefore, we will not count January and February, but we will count March, and that would give us 10 months. Okay, so you see how that's the difference there. So we have to figure out 9 months of depreciation for this equipment. Now I'm going to bring you back here. The 16,000 was our yearly amount. So we're going to take that yearly amount, which we have to calculate anyway, because the next year it's 16,000. So we know our yearly amount is 16,000, and that is from the previous calculation, and you have to do this anyway. So once we've got our 16,000, we're going to say, okay, we have 9 months out of 12. So this is 9 months out of 12, or 9 twelfths of a year. We're going to multiply the straight line 1 year amount by 9 twelfths. So I'm going to take my 16,000 times the 9 divided by the 12, and that is 12,000. So if you're sharp on your math, you knew that that was 3/4, and 3/4 of 16 is 12. So you can do this in your head if you want, but sometimes it comes out to a strange number. So that just gives us our amount for this current year, and then the entry itself is the same. So it's still depreciation expense debit, accumulated depreciation credit, except here we know we want $12,000. There, and that's all there is to it. Okay, so let's practice one, and I'm going to give you another purchase, and what I would like you to do is pause the video, and I want you to calculate the depreciation expense, and then come back to the video and see how you did. So I'm just going to make this up. Purchased equipment for $240,000 cash on October 12. Useful life is 12 years. And residual value is $30,000. Okay, so at this point, pause the video. I would like you to figure out the amount of depreciation to record in the first year of the purchase of this machine. Okay, so let's say you've figured this out, and let's note that the entry to record depreciation in terms of the ledger accounts is always the same. So we have depreciation expense and accumulated depreciation. Now let's figure it out. We're going to start with $240,000. So here's my 240. And it says here that the useful life is 12 years and the residual is 30,000. So we're going to take the residual and we're going to take it away. Now I'm just going to do this by hand. I know that's 210. So we have 210,000 as the amount to depreciate. Now this is good for 12 years. So we're going to take that and we're going to divide by 12. So that's $17,500 per year. I imagine that everyone probably got that far. Now let's look at how many months we're going to depreciate. Keep in mind that October 12th falls between the 1st and the 15th of the month. Therefore, we're going to round down to October 1. Therefore, we need to count October, November, and December. So we're going to have 3 months out of 12 to depreciate. So I'm just going to do that here. I'm going to take the 17.5. We're going to multiply by 3, and we're going to divide by 12. So that's our 3/12 of the year, and there's 43.75. So all we do, now that we've calculated that amount, is plug it into the debit and the credit. Whoops. Anyway, hang on. That's better. Is 43.75, and this, of course, is our end of year adjusting entry on December 31. So that's all there is to it. And in the next video, we're going to look at another commonly used method of depreciation, the declining balance method.